Let's look at TD specifically, actually, a bank that has recently been in the headlines over its failed deal with First Horizon. We got some strong commentary from the research team at Bank of America before that company's results, suggesting that investor confidence in management has waned as the bank navigates through some of those U.S. growth plans. Bank of America has maintained its buy rating on TD. It is also the only Canadian bank they have a bullish view on. Let's get some more perspective. Ebrahim Poonawala is with us. He's head of North American Bank Research for BofA Securities. Thanks for being with us. I guess we'll start with the TD story because that one has gotten so much attention, obviously, with the decision not to pursue that big deal in the United States. What's your general take on TD right now?
John, thanks for having me. In terms of TD, we do see a stock that is significantly discounted relative to the franchise value that TD has. And what do we mean by franchise value? It goes back to the quality of their client relationship. You've talked a lot about deposits in terms of deposits on both sides of the border, both in Canada and the US. It has one of the best North American retail banking franchises, trading at a discount. And now, as you alluded to, following the termination of the First Horizon acquisition, they also have a ton of excess capital, which we like right now.
Yeah, I'm curious, what would, as an analyst, how would you like to see that capital used? They already indicated after they reported their results, they putting some of that to use in shareholder-friendly ways. So, as an analyst or as a shareholder, what you want to make sure is management is being extremely thoughtful in how you're deploying capital. For any of these management teams, the single biggest important decision that they have to make is capital deployment. And as we look out over the next year or two, both in Canada and the US, we don't think there's going to be a shortage of opportunities for the bank to deploy that capital. So we were happy to see the buybacks being announced along with earnings last week. And I think some steady capital return will be welcomed by shareholders who we've spoken to. But I think over time, there will be plenty of opportunities to deploy that on M&A. And the last thing you want to see is management rushing into it. Right, and so should I take from what you're saying, because there were some suggestions that after the First Horizon deal ultimately did not happen, that maybe TD would have a bit of a stall in terms of doing more activity in the U.S. But it sounds like you think there still could be a possibility for another deal at some point.
So it seems less likely that we'll see a bank M&A deal in the U.S. in the near term, right? We are not sure of what the issue was that led to the termination and the delay in the U.S. regulators approving the First Horizon acquisition. So whatever that issue is will need to be resolved before they can return to bank M&A in the U.S. So it may not be something that happens over the next few months or even this year, but over time we do see TD as a potential acquirer. They made it clear in terms of the importance of the U.S. market for them when they outlined plans to open about 150 stores across the U.S. Southeast over the next few years.
Okay, now by comparison, we were showing our audience some of your outlooks for the different banks. CIBC had quarterly results that were better than expected. It is a more Canadian-focused bank than some of its peers. You've got a somewhat cautious view on that business. How come?
So we have a cautious view, generally speaking, right? If you take a step back in terms of our outlook on the entire group going back to last year, what we've said, John, is we do worry about higher for longer interest rates and its impact to weigh on the economy, both in terms of growth, but eventually in terms of credit quality as well, squeezing the consumer as you look at some of these mortgage debt payments repricing to the higher rate backdrop. So we worry about the overall outlook for the Canadian economy. CIBC obviously most indexed to the economy, not that any of the banks will be immune if Canada has a severe downturn. But you're right in terms of when you look at the results in 1Q, Commerce actually had a pretty good quarter and the stock reacted positively, was one of the only of the big five banks to actually beat expectations.
And outside of some of the factors that you have highlighted, how closely are you watching the health of, let's say, the housing market, which all of these banks have exposure to? So we're watching it closely, more in terms of what that means for the consumer, right? Like there have been investors who've been calling for the demise of the Canadian housing market for over a decade now, but you understand this in terms of the resiliency of the market, the role immigration plays, the demand-supply dynamic. So we are watching the health of the housing market in that if we are in a backdrop where rates remain higher for longer, and for all we know, Bank of Canada needs to come back and actually hike interest rates, if there is a significant negative impact on Canadian home prices and a more lasting impact on activity, we worry about what that means in terms of consumer behavior. Again, losses within the mortgage market may be limited, but its impact on the consumer spending is something that we are closely watching. And I think eventually how the job market behaves is what's going to drive whether or not this really becomes a credit issue or not, and how meaningful.